Hello and welcome to this session. This is Professor Farhat. In this session, we would learn about how to set preliminary judgment of materiality, or simply put, materiality for the financial statements as a whole. In the prior session, we looked at the concept of materiality. So if you don't know what materiality is, please look at the prior session. And we concluded that materiality is a professional judgment. The way we arrive to materiality, depending on the industry, certain standard, the financial statement of the company, the size of the company, what's important to the company. So it's, at the end of the day, it's a professional judgment. Although it's a professional judgment, we have to set some sort of a materiality, a number amount. In this session, we set materiality for the whole financial statements. Now, in the next session, we will set materiality, what we call the performance materiality. This will be the next step. So what is materiality? Let's go back and review real quick. It's the maximum amount by which the financial statement can be misstated without affecting the decision of a reasonable person. So we missed something, but whatever we missed, it's not large enough. It doesn't go above a certain amount that we are comfortable saying that the financial statements are fairly presented, free of material errors, because that error that we missed is not large enough to affect the decision of a reasonable user. Remember, how do we come up with that number? It's a professional judgment. Now, bear in mind, this judgment is not set in stone. Materiality could change. It can change as more information becomes available during the audit process. But at the end of the day, materiality will determine the scope and focus of an audit. It tells you whether you need to audit something more or less. It determines the scope and focus of the audit. So everything that we talked about this point is a review, and let's emphasize a little bit more about determining the scope and focus of the audit. We have to understand the relationship between materiality and evidence. Remember, we have to collect evidence to provide reasonable assurance. Now, what's the relationship between the two? Well, if you want to have a level of materiality that is, let me just throw a number, starting with $100,000. So you can live with a materiality level of $100,000. Simply put, what we are saying is this. If we missed certain figures that are less than 100,000, just go along with me, we assume that whatever we missed is okay, is not material in the grand scheme of things, and we'll accept the financial statement as fairly presented. Now, if we set materiality rather than 100,000, what we're going to do, I'm going to lower materiality to 70,000. When I lower my materiality from 100,000 to 70,000, what's going to happen is this. Anything that we miss that's above 70,000 is material. So notice, those three X's were not material when the materiality was 100,000. Why? Because they fall below the materiality level. Now they are important. Why? Because if we set materiality at 70,000, those three errors, those three X's, are material because they are above the level of materiality. So the level of materiality set by the auditor has an inverse relationship with the amount of the audit evidence required. What does that mean? The lower you set your materiality, the more work you have to do. Why? Because the lower your materiality, the greater the chances of having errors above that problem, above that figure, not that problem, above that materiality. And the probability of more having figures about this materiality, the more work you have to make sure you don't have any errors above this problem. So if the auditor sets a lower materiality, it implies that even a small misstatement are considered significant. So notice as I dropped from 100 to 70, I have three misstatements are considered significant. It means I have to do more audit work to make sure I catch those statements that are above 70. Now, for the sake of illustration, let's set materiality at 0. What does that mean? It means I want to make sure I catch every error, because simply put, every error is considered material. And if you want to catch every error, every misstatement, what do you have to do? You have to audit everything 100%. What does that mean? It means as materiality goes down to 0, evidence goes up, you have to collect more evidence. I want you to keep this relationship in mind. This is an important relationship. If you set your materiality low, you have to collect more evidence. Why? Because now everything is material, and because everything is material, you don't want to miss anything that is considered material. But if you set your materiality high, anything that you miss, it's not as important because you're going to miss less because the problems are above the materiality level. So if the auditor sets materiality threshold lower, it implies that small misstatements are considered significant now. Consequently, the auditor would need to gather more evidence to ensure that the financial statements are free of material misstatement. Well, and if we set materiality higher, on the other hand, if the materiality level is higher, fewer details are looked at, reducing the amount of evidence that needs to be collected. Again, what type of a relationship? An inverse relationship. Now, the next thing I'm going to talk about here, up to this point, basically, it was a review. I'm going to talk about factors that influence the setting of the preliminary materiality. In other words, what factors the auditor takes into account when setting this preliminary materiality or materiality for the financial statements as a whole. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
So what are the factors? There are three factors. One, we have to understand that materiality is a relative amount. It's not a specific dollar amount. So the literature, the AICPA, NASBA, no one gives you a number for materiality. Materiality is a comparative concept, not fixed, and depends on the context of the financial statement. So for one company, 100,000 could be material. For some other companies, $1 million may not be material. For other companies, $10 million may not be material, depending on the size of their financial statement. Also, when we are setting materiality, we have to have a frame of reference. We have to have a benchmark. Benchmarks are essentials for assessing materiality to gauge what might be considered significant. So what is something significant? Is $100,000 significance? Well, we have to compare the 100,000 to something else. And when we compare it to that frame of reference, we can make a better judgment. Also, there are qualitative factors. Materiality is not only quantitative, it means it's not only based on numbers. Qualitative factors also play a crucial role in shaping these judgments. So I'm going to go over each one of those separately, emphasizing on them because this is what helps auditors set materiality. Relativity of materiality, it means the question of whether like 100, 100,000, 10,000 or $1 million are material cannot be answered in absolute terms. Why? Because materiality is relative. This ties back to the first factor affecting materiality, the relativity of materiality that we talked about in the previous slide. This variability underscores that materiality is relative and requires auditor to rely on, again, we're back to professional judgment. Now, this judgment is influenced by what? First, the size of the company. If the company is large, generally speaking, your threshold will be higher because the larger is the company, smaller errors, which should not be a big deal. For example, if you're auditing a mom and pop store, maybe $5,000 is an important figure. If you're auditing a company, a publicly traded company like Apple Computers, maybe $50,000 or even $5 million may not be material when their sales is $100 billion a quarter. The expectation of its financial stakeholders. What's the expectation? When we're looking at creditors, investors, and other stakeholders, what is important to them? Well, that's going to determine our materiality level. So those are the things that we'll take into account, making materiality a relative amount rather than a fixed threshold. Also, what we need to look at is looking at this number relative to something else specific. So the statement benchmarks are needed for evaluating materiality emphasize the necessity of using specific contextual financial matrices to determine what amount are considered material in the audit. So we have to take a look at this number, compare it to a benchmark, and make that decision. So different benchmarks works best for different type of companies because each company is different. They have a unique financial structure and industry context. For example, earnings before taxes could be a good benchmark. So we would look at 3 to 5%. We would say anything below 3, not material. Anything above 5% of earning before taxes is material. Anything in between, we have to kind of use our judgment. Great. What if we have no earnings? What if you're auditing a company that's incurring a loss? For example, startups. They don't generate profit. I believe as of now, either Lyft or Uber don't generate earnings. They are operating at a loss. So how do you audit those companies? They have no earnings. They have no earnings before taxes. They have losses. Therefore, earning is not a good benchmark. Maybe you want to look at their percentage, 2% of their sales. This is useful. So you would use percentage of revenue if you are growing your sales. So if the company is focusing on growing sales, we would use a percentage of sales revenue as a benchmark to determine the level of materiality. Or we can look at gross profit percentage. For example, for retailers like TJ Maxx or Macy's, the gross profit percentage is an important figure for retailer. Therefore, we would look at the error relative to their gross profit percentage. Why? Because for the users of the financial statement, the gross profit is an important financial figure. Therefore, we would look at the error relative to that figure. Notice different companies will have to use different benchmarks. Or we could look at the 3-year average income. This benchmark might be used for industries or companies with volatile earnings over year. If that's the case, we would look at 3 years of income, average them, and we would look at the error relative to that 3-year. Why? Because over 3 years, we have a good idea what's important to the company, and any percentage of an error above that average, we should say considered important. So this is why we have benchmarks. Also, we would look at qualitative factors, factor that has nothing to do with numbers. Like what? Let's assume the error influences the loan covenants. What's a loan covenant? Loan covenant is a loan agreement. So when you take out a loan, what happened? The bank will impose conditions on you. For example, maintaining a certain working capital or a current ratio. What's a working capital? Current asset minus current liabilities. What's current ratio? Current assets divided by current liabilities. For example, let's assume the bank says you have to keep a working capital of $250,000. So your current assets minus your current liabilities cannot fall below $250,000. Well, if the error influenced this number, so for example, without the error, your number is, or with the error, your number is 255. Once we adjust the error, we'll go back to 248. Well, we have to adjust the error because the error will do what? Will influence this loan covenant. The error becomes important. Why? Because it's influencing the loan covenant. So even minor deviation from the covenant in loan agreement can be material because they affect the company's ability to continue as a going concern or lead to a loan default. What's going to happen is this. If you reported working capital at 248, then the lender might impose additional penalties, might ask for them to pay the loan, impose a higher rate. So that's important. That becomes material. And you have to be fair to the lenders because you want to protect them. It becomes an important, a material figure. Change from loss to a profit or vice versa. A small amount that shifts reported result from a loss to a profit or breaks even can be highly material as it influences perception or financial health and stability, impacting stockholder decision. So if you have a company right now and they're reporting negative $10,000 in income, and guess what? If there's an error and that error is not corrected, it's going to take them to $5,000 profit. Although the number may not be material, going from negative 10 to plus 5, which is a total of 15, it becomes material because you're going from a loss to a profit. So this is a psychological change that's important, or that's going to take you from a loss to a break even. So here, any error will becomes material. Also, you want to look at management incentive and compensation. What does that mean? Adjustment that affect management compensation, such as bonuses tied to a specific financial target, can be material. If the error, for example, the company will have a policy, we have to meet earnings of 10 million before bonuses are given. So if the error is going to take profit above 10 million, it becomes material. Why? Because now there's an incentive for management to do what? To accept that error, which is not good. Why? Because they want to get their bonus, because they only get a bonus of, let's assume 10% if they exceed 10 million. If they don't, their bonus is 5%. So if that's the case, any error that takes you above 10 million becomes material regardless of its size, because we are looking now at qualitative factors. Other qualitative factors is, for public companies, it's the stock market pressure. Even a slight misstatement can be material if it has an influence the stock price, investor perception, or market stability. Now, when you report your numbers in the financial market, you report everything at the end, earnings per share. Now, earnings per share could be like, for example, $1.15. Well, if the investors are looking at this number, that's what they're expecting, and right now the company actually is only making $1.13 per share, and the error can take them from $1.13 to $1.15. It becomes material. Why? Because it's changing the perception or the influence on the stock price, because everybody's expecting $1.15. If they reach $1.13, the stock will drop. Therefore, the error becomes important. So those are qualitative factors that the auditor will have to look at, and if they exist, it's material. Risk of bankruptcy. Financial information indicating an increased risk of bankruptcy, even if numerically small, can be considered material due to its significant implication for creditors, investors, and other stakeholders. What does that mean? It means if the error not corrected, although it's a small amount, not a large amount compared to any benchmark, but it indicates that the company is not doing good, there's a risk of bankruptcy, it becomes a material error. And the last one is any act of fraud, regardless of the monetary amount. If the issue is fraud, not an error, not a mistake, not a misapplication of accounting, fraud means what? Fraud means someone intentionally cooking the books. It doesn't matter how small it is, it becomes material. Let me tell you something about fraud. Not seldom, never fraud in one place. If you find a fraud here, there's fraud here, there's a fraud here, there's a fraud here, there's a fraud everywhere. For one thing, from the nature of accounting, accounts are interconnected. So if you find fraud in sales, okay, let's go through this. Sales will affect account receivable. Well, there's going to be some issue in account receivable. Sales affect sales return and allowances. Sales will affect sales discount. It might also affect if we're giving warranties on these sales. So notice, just from the nature of accounting, once one account is misstated due to fraud, there are going to be other mistakes. As I mentioned also, look, if the company is committing fraud using sales, there's a good chance they are also committing fraud through cost of goods sold. Because if you are unethical and you manipulated your sales, there's a high chance you're manipulating other figures. And if you manipulate cost of goods sold, it means you are manipulating inventory, you are manipulating accounts payable, you are manipulating your cash payment. And for sales, you're manipulating your cash receipt. So fraud, it doesn't matter how small it is, once it exists, you have a problem. The problem is material. This is due to the legal implication for one thing, potential impact on stakeholder trust, and the integrity of the financial reporting process. Once fraud exists, that's it. You should lose any trust in management. Now you should be on the lookout for more information. You should be on the lookout to find where else can you find fraud, because seldom fraud is limited to one area. That's not how it works. No one's gonna cook the books in one place. That's not how it works. Now let's take a look at some numbers, because it's good to kind of see how materiality, what does it mean relative. So let's assume we're looking at a company that have earnings from operation 7.5 million, current assets are 100 million, total assets 250 million, current liabilities, let's assume 25 million for the sake of this illustration. Well, what can the company do? They can say, okay, we're going to use earnings from operation. The range will be 2% and 5%. What does that mean? It means we're going to look at, this is the number, the benchmark, and we're going to be using 2%. So anything below 150, which is 2% of 7.5 million, is not material. We can live with that. Below 2% of 7.5 million, no problem. It's considered immaterial. Anything above 5%, any problem above 5%, which is 375, is considered what? Materials, 375,000. How about if the problem is in between 150 and 375? This is where the auditor will have to use their professional judgment. Or if they're using current asset as their benchmark, they would say 2% of current asset, which is 2% of 100 million is 2 million. This is the minimum. Anything below 2%, we can live with it. Anything above 4, we cannot. Anything in between is a problem. If we are using total asset as 250 million times 1%, this should be 2.5 million. And if we're using an upper threshold of 2%, it should be the double of that, it should be 5 million. So again, anything above 2.5, assuming we're using total asset as the benchmark, is fine. Anything above 5 is not acceptable. And in between, we have to use our professional judgment, and the same thing with the liability. So here what we're doing is we're setting the materiality for the financial statement as a whole. We're going to look at performance materiality later. But this is what you need to know about setting materiality, or the preliminary judgment of materiality for the whole financial statement. Let's take a look at this multiple choice question from farhatlectures.com. In auditing, if the auditor sets a lower materiality threshold, what's the expected income on the amount of evidence required? So if materiality goes down, if we set a lower amount of materiality, how is that going to influence the evidence that we collect? Are we going to have decrease in evidence, increase in evidence, stay the same? Is not related. Is it related? Yes. So it doesn't stay the same. Is it? Sorry. Do we collect more evidence or less evidence if we set materiality down? If we set materiality down, it means we are having a low threshold. So what does that mean? It means there's a risk of missing a lot of amount because the threshold is very low. Therefore, what we have to do is we have to collect more evidence. So there's an increase in the amount of evidence if we set materiality at a lower threshold. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you if you're studying for your auditing course, the CPA exam, or some other professional certification. farhatlectures.com is always here to help. Invest in yourself. Good luck. Study hard, and of course, stay safe.